Welcome to The Explainer. Today, we are diving deep into the high-stakes world of due diligence. We're going to show you how the pros uncover the truth before a single dollar gets wired.
Okay, let's get one thing straight right off the bat. So many people think a signed term sheet is the finish line. Nope, it's actually the starting pistol for the real investigation, the part where fortunes are either saved or lost based entirely on what you find next.
And this is exactly where that real work kicks off. This isn't about just ticking boxes on a checklist. No, this is the phase where you are intentionally stress testing every single assumption you have about a deal, literally hunting for those hidden fractures before it's way too late to back out.
So let's reframe this in our minds right now. We're not administrators, we're detectives. Due diligence isn't some boring paperwork exercise, it's a high-stakes hunt for the clues that make or break a multi-million-dollar investment. It's all about separating a company's story from its reality.
Every good detective needs a toolkit, right? Well, in due diligence, your tools are the different lenses you use to examine the deal. Each one gives you this unique perspective and helps you spot a totally different kind of danger.
This here is the perfect roadmap. It breaks the whole investigation down into 5 critical angles. Think about it. A company could have amazing financials, but a fatal flaw in its legal structure. Or it could have incredible tech that, violates a key regulation. You need all 5 of these lenses to see the whole picture, not just the pretty parts the seller wants you to see.
All right, let's get to the heart of any investigation, following the money. This is where you find out if a company is really as profitable as they claim, or if there's some, let's say, creative accounting hiding the real story. And here is the first major tool in our financial toolkit, Normalized EBITDA. Now, what on earth is that? Well, think of it like this. Let's say a company had a fantastic year on paper because they sold their headquarters for a massive one-time profit. That's not a repeatable thing, right? Normalizing EBITDA basically strips away that one-off gain to show you the true, steady earning power of the actual business. It's all about finding the financial reality, not just a good story.
And believe me, the financial clues are everywhere if you just know where to look. We're hunting for things like hidden tax exposures that could turn a great company into a financial black hole, or personal guarantees, where a founder has tied their own house to company debt, creating a huge risk for everyone. Each one of these is a potential landmine just waiting to be stepped on.
Now, beyond the financials, some of the absolute deadliest risks are buried deep inside legal documents, lines of code, and the company's org chart. This is where you find the really non-obvious traps.
Take shareholder agreements, for instance. Drag-along and tag-along rights, they sound almost the same, don't they? But they have completely opposite effects. One protects the majority's power to sell the whole company, while the other protects the little guy from being left behind. Knowing the difference tells you who really controls the company's future.
And the hunt for these traps goes on and on. Is all the critical intellectual property actually owned by the company, or does it legally still belong to a founder who could just walk away with it? Do key customer contracts have a little clause in there that lets them cancel the second you buy the business? These are the kinds of vulnerabilities that can absolutely destroy a deal's value overnight. Speaking of customer concentration, here's a number to burn into your brain. As a rule of thumb, if any single customer makes up more than 15 to 20% of revenue, that's a massive, flashing red light. That's a huge dependency risk. If that one client walks, the company's value could just plummet.
So what are the smoking guns? What are the things that have actually killed deals in the real world? This isn't theory anymore. These are the discoveries that stopped investments dead in their tracks.
I mean, just look at this list. These are the real nightmares. A founder using the company like a personal piggy bank to buy real estate. A crypto project that sold tokens before the company even legally existed, creating a huge legal mess. Or finding a politically exposed person on the board, which opens up all kinds of risks. These are the actual gotchas that have saved investors from catastrophic losses.
So here's the crucial pro tip. You gotta be strategic. You run your financial and legal checks at the same time, in parallel. But the regulatory stuff, you hold that back. There's zero point in spending a fortune verifying the financials of a business that can't even get the license it needs to operate. You sequence your investigation smartly to avoid wasting time and money on a deal that's dead on arrival. So, after seeing all these potential traps, the final question isn't just if you should investigate, but where you absolutely must start digging first. Because in the world of high-stakes investing, the truth isn't just out there, it has to be hunted down.